Today's topic of tax advantages of investing in real estate. I am Mallory Meehan. I am a professor of real estate. I am also the creator of Inspire Wealth Education, which is a series of real estate investing courses. So at the end of this, I will give you more information about that if you are interested in learning more. But today I just wanted to cover some high-level tax advantages that you can take as a real estate investor. So of those tax advantages that we're going to cover today, we're first going to look at the opportunities you can use to invest your money in real estate. We're going to talk about all of the tax deductions that you can take within specific real estate assets, go over capital gains tax advantages and understanding what capital gains means, diving into 1031 exchanges to try to defer any of those capital gains, and then talk about some tax benefits for a real estate professional, which is key, especially if you have a W-2 that you're looking to offset some of that earned income. So moving on into investment opportunities. Within real estate, there are several different opportunities that you can invest your money in. Primarily, most people think about residential properties, and this is a great way to have cash flow coming in, also having appreciation. And residential properties have a number of different avenues. So you could invest in single family, you can invest in multifamily. So a lot of different avenues to invest specifically in residential. Then we can switch to commercial properties, and commercial properties are going to be those properties that typically are office buildings or other general types of businesses that are occupying those spaces. And with commercial properties, we generally see higher yields, meaning we see higher returns than we may in residential. And those are typically also on longer term leases. Residential properties are typically on 12-month leases, and commercial properties can range, but generally speaking, are longer than 12 months. They're more so in the 3+ year range. You can also invest in industrial properties, and this is an area of commercial real estate that has been booming recently. When you think about industrial, these are your manufacturing facilities, logistics, distribution hubs, and often these particular types of properties are under what we call a triple net lease. And a triple net lease is when a tenant is responsible for all expenses. And so this is a great avenue when you are a owner and you can have your tenant essentially taking care of all of the day-to-day operations of the property, including repairs, maintenance, taxes, and insurance. So it's a great lease option. We also have retail properties. And again, these are going to be your shops that consumers are coming to, typically located in retail centers or mall settings. And those can sometimes be based on leases that also allow the landlord to acquire some of the earnings from that particular business. Those are generally called percentage rent leases. And that means that once that tenant hits a certain amount in sales, a percent of that will then be distributed to the landlord as a part of their rent. We also see a lot of new development, specifically in the mixed use space. And so mixed use developments are when we have both a residential component as well as a commercial component. And these are generally what we're seeing pop up in a lot of urban and suburban settings where you see apartments on top of coffee shops or on top of gyms or other types of businesses that are on the lower level that those people living there and those people living in those communities can benefit from. One area of real estate that a lot of people aren't as familiar with are real estate investment trusts or REITs. And a REIT is essentially a stock that a portfolio manager, usually insurance companies or other asset managers, own within a particular space. And so you're not actually buying into a specific property, but you're buying into several shares of multiple properties on a larger scale. And so REITs are generally traded on the stock market, and you can check those out. Depending on what area you're interested in investing in, you can typically find a REIT that focuses on that particular area. We also see vacation rentals, and so these are our short-term rentals that generally see a higher rate of return than long-term rentals, and these are usually located in tourist or vacation destinations. As a short-term rental, you'll generally be renting on a per day basis versus a per month basis, so that's why we're seeing higher returns. And then finally, you could also invest in land, raw land that hasn't been developed, that you maybe are buying out of expectation that this is going to appreciate in the long term. Maybe it's close to a major highway. Maybe it's close to an area where you're seeing a lot of business growth. And so you can get in on that land early. And whenever it is looking like an investor is planning on using that particular location, you can generally sell it at a much higher rate to that particular developer. So moving right along into deductions. Now, these are very high level scope of what real estate property is used for deductions. And so the first one we see is the mortgage interest deduction. Now, if you own any sort of investment property, any interest that you pay when you have debt tied to it is an automatic deduction. This also includes PMI, private mortgage insurance, which if you are buying commercial properties, generally speaking, you're going to include up to 20% of a down payment. So PMI is charged if you don't come with 20% down. But if you did have a situation where you were able to get a loan for less than a 20% loan to value ratio, you would still be able to deduct the private mortgage insurance. Property tax deductions, unlike our primary residence, we have no limitation on the amount that you can use for a property tax deduction. So whatever those taxes are for that particular property, you're going to be able to use that entire amount as a deduction. Similarly, if you have any repairs or maintenance for the property, those expenses are also completely deductible as long as they are not considered improvements. And we'll get into improvements here in a little bit and what the difference is between repairs and maintenance. Other deductible expenses that you can use are your insurance, utilities that you cover for your tenants, if you pay a property management fee, or any other business expenses tied to the property. Now, beyond those deductions, we have this magical thing that I like to call depreciation. Depreciation is essentially creating money out of thin air. And so what do I mean by that? Most residential properties, and we'll focus on residential and commercial, but most residential properties are allowed 27.5 years of depreciated life. So what the IRS says is that the value of the property is declining over time when it comes to the actual physical purpose of the property. Now, is every property going to die after 27.5 years? No, of course not. But it is considered its useful life. And that useful life resets when a new property owner acquires it. So if I buy a residential property that I plan on using as a rental, I'm allocated 27.5 years of the purchase price that I get to use as an additional deduction on my taxes. So again, essentially creating money out of thin air. Now that rule is a little bit different for commercial properties because we imagine that commercial properties are built a little different and they have a longer useful life. So their useful life is 39 years. So you would depreciate that total amount over 29 years. Now, one caveat to this is that only the value of the building can be depreciated. Land does not get included in depreciation because the land doesn't get used up. The land's useful life continues well beyond that property on top of the land. So we have to be sure that we are focusing on what is the value of the land and then what is the value of the property on top of the land, because that's where our depreciation comes from. Now, not only do we get to depreciate the value of the property, but we also get to depreciate the value of improvements. So if you added an addition, or you replaced appliances, or you put on a new roof, all of those expenses get to be depreciated over time based on what the IRS has allocated for that particular type of improvement. Now, one thing that people are always hesitant is, if you do depreciate, which I recommend everybody does because the IRS is going to assume you have depreciated, you will have a recapture when you do go to sell. So what does that mean? If you've depreciated the property over 10 years, that value that you now have as far as taxes are concerned has been lowered. Let's say we bought a property for $100,000 and we've now depreciated that property to having a value of $70,000. If I were to now go and sell the property for $200,000, I now have to show that I have a capital gains of $130,000. The value of the property being 70, and I'm now selling it at 200. So you will have that recapture. That $130,000 would be what you would be taxed on, regardless of whether or not you took the depreciation on your taxes. So that's why it's key to always take depreciation regardless of the outcome. Now, when we're focusing on those capital gains and the tax advantages that you have for long-term investments, long-term capital gains is a lower rate than what we see as a standard tax rate. So if you yourself are investing in something that you only hold for less than a year, you are going to see that you're taxed at a much higher rate than if you hold an investment for a longer period of time. And this applies to any sort of investment, not just real estate. So this could be stocks, this could be, anything else that you are investing in. Now, one of the key things to help offset some of these capital gains is investing specifically in opportunity zones. Now, opportunity zones were created when we had the Tax Reform Act in 2017. And essentially what these do is they offer tax incentives for investors to invest in properties that have been identified as economically distressed. So if you take your money and you put it into an area that is needing some growth, or has shown that the overall general income is lower than the average, then you're going to be given a tax benefit for holding that property and investing in that property. If you hold your investment in an opportunity zone for over 5 years, you get a reduction of 10% on your capital gains tax. If you hold it for 7 years, you get a deduction of 15%. And if you hold the property for 10 years or longer, you basically don't have those capital taxes as a obligation to show. So essentially they get wiped away. Great thing when it comes to investing in real estate, especially if you're looking for the long-term play. Now, one other key thing with capital gains that I want to dive deeper into is the 1031 exchange. The 1031 exchange is a IRS code, that's code 1031, and it allows investors to continually defer any capital gains if they reinvest those gains into another like-kind property. So let's dive a little bit deeper into 1031 exchanges, because this is probably one of the best tax advantages when it comes to investing in property. So what is a 1031 exchange? Again, it is a like-kind exchange, which like-kind exchange just means any property, as long as you're investing in an actual property. So you may have had a single family home rental and you maybe want to get into multifamily. You can still do that. It doesn't have to be the same exact type of property. It just has to be a property. Now, all of the proceeds that you get from the sale of that first property must be reinvested again into a similar property that has equal or greater value than what you just sold. Now, what are the key benefits here? This allows you to continually defer your tax. So any capital gains tax that you had shown on this investment, if you've held the property for 10 years or longer and you now have depreciated it so far that you are experiencing a high amount of capital gains, this is crucial. This is going to be where you can avoid having that huge tax bill. You also have a portfolio growth. So now it allows you to take that money and reinvest it into another set of properties that could potentially have higher returns and allow you to diversify. So rather than you having just one single family property, you can take that money and put it into several properties now, expanding your opportunities and not having a tax liability. This often allows greater flexibility because you now have the opportunity to either consolidate or diversify within multiple different properties. So when we are looking at a 1031, it is essential to be sure you follow the timeline that's prescribed. So the timeline looks like you first start off by selling your property. Once you have a contract signed on your property, you then have time to find a replacement property. So a 45-day identification period begins at the time of closing. So when you closed on your property, you now have 45 days to identify potential properties that you want to then reinvest in. Now, after that 45 days, you have to actually move forward with purchasing one of those properties, and you have 180 days to complete that purchase. Now, you also have the ability to purchase more than one property. So the properties that you identify, though, are the ones that you have to invest in. You have to invest in either one, or you have the opportunity to invest in up to 4 properties with the money that you made from your original sell. Then, if you've completed all of these steps and you've had what we call a qualified intermediary handle the proceeds, where you know you do not have any obligation or any touching with this money, you then can defer all of the capital gains taxes, which is a huge benefit when you're investing in real estate. So, last thing I want to cover with our real estate taxes is real estate professional status. This is probably one of the biggest key things, especially if you have a W-2 and you're investing in real estate, that you want to try to strive for. What does it look like? You don't have to be a real estate agent. You don't have to be any full-time real estate professional per se. You just have to be involved in your real estate business. So the key thing is that you are performing at least 750 hours in real estate service every tax year. And of those 750 hours, half of those have to be related specifically within your real estate investments or your real estate business. So you could be spending half of your time analyzing properties, attending open houses, finding partners to invest in. That will still count towards these hours. Now, if you meet that hourly requirement, you can then fully deduct all rental real estate losses against your other income. Why is that so important? Because with real estate investments, you can most likely show a loss. Because you're going to be able to deduct all of your expenses and you're depreciating, most of the time you are going to be able to show that you didn't get any cash flow, even though you may have gotten cash flow, which I hope you all do. But because you're able to show that loss is now going to be able to offset the income that you make on your W-2 and reduce the amount of income that you have to show for your taxes. And there is no limitation. that is the best thing about this. This can significantly offset other taxable income. So those who are high earning professionals, maybe doctors, lawyers, professors, all of those types of individuals, and obviously anything that I haven't covered, those are the people that are going to benefit the most from this because they are going to be able to show they have losses on one business and they can lower their income liability from their W-2s. So those were all very high level, in-depth overviews of some of the key tax benefits of real estate investing. If you're interested in investing yourself, obviously like this video, follow us. I am at Mallory Inspires Wealth and Mallory M. Meehan on Instagram, Facebook, and Twitter. Check out our courses that we offer at inspirewealtheducation.com to learn more. And I do have courses that are specifically related to these taxes that dive into a deeper understanding of all of the benefits, how to structure your businesses when you're acquiring properties, and I am allowing you to interact with each other and interact with me to help you be successful in real estate investing. Till next time.